Wonderful. We have our panelists on. Everyone, thank you so much for taking the time to spend your Friday afternoon with us here. I know it's been a crazy week, crazy couple weeks, crazy month. It's really positive to go into the weekend with an up S&P, an up Dow, an up Russell 2000, Russ, everything's up. So that's great. Makes me happy going into the weekend. And my wife can definitely tell that my attitude is much more positive for the remainder. So hopefully everyone feels the same way. With that said, we're actually going to be doing a lot more of these moving forward. So every couple weeks, probably every 2 weeks, our team in Chicago and as Buff as well, he's in our Indiana office, we'll be doing these types of meetings, just to kind of overview of the week, overview any updated geopolitical events, all that stuff that you can kind of get into the mind of our team and all that stuff. So I'd like to have more guest speakers. Last time we did this, we had our partner from Arcadios Capital. But we're actually in talks with companies like Vanguard and First Trust to have more folks on the line to kind of talk above and beyond just the portfolio stuff, so the practice management stuff. So the next call that we're going to have in 2 weeks will actually be featuring someone from Vanguard to talk more like advisor alpha stuff, so practice management. So be on the lookout for that. We want to make these as relevant and as helpful to you all as possible, but that's kind of our thought process. So hopefully these are well received. I've been getting a lot of good feedback. So I will be recording this. I will be sending out my highlights as I did in the previous weeks. So be on the lookout for that. I should have that over to everyone by tomorrow. I'll probably work on that this evening. But with that said, we have the standard breakdown. So we're going to have our panel, which is 3 portfolio managers on the Kingsview Investment Management team. Our Chief Investment Officer, Scott Martin, Senior Vice President of Investments, Paul Nolte, and then finally, Buff Dormeyer in our Indiana office. Very, very hopefully linear, and hopefully we'll be able to answer everyone's questions. At the end here, if you notice on the top bar of the Zoom meeting, you will see a Q&A function. Please direct all your questions there. We will have an open discussion for that. Everyone is muted. So we will be taking all questions, any and all questions via that. So with that said, I thought I'd hand it over to our CIO, Scott Martin. Scott, thanks for joining, my friend.
Yes, thank you, Alex. And everybody can hear me okay?
Oh, yeah.
Lovely. Wow, good start, Alex, to the call. You, as usual, have spoken almost better than me, actually, in the case of the summary, because you're right. Good to see, I think, in general, folks, markets calming a bit. And I know that's a funny thing to say with the Dow up 700 roughly, but the reality is the following. I believe, as our investment committee does, of whom, Alex, as you mentioned, we have a couple members of which on this call, that the markets are starting to internalize and, let's just say, deal with and digest perhaps the data that is coming out, in the sense of we're starting to get good data that gets good reactions. We're starting to get bad data that doesn't get as bad of a reaction. And I look to that evidence no further than saying some of the overnight markets. Those are overnight markets that many of you know are the futures markets, and markets that are trading when a lot of the eyeballs are not watching them, at least especially on the retail side. And you're seeing a lot of data flow come in kind of after hours. And some of that data flow is not pushing around the markets as much. And to the point of something that I think is very important, something we take very, very seriously at our investment committee and our investment committee meetings and the portfolios we run within Kingsview Investment Management, the downside capture and the downside volatility is just not present as strongly as it was some say month and a half and certainly month ago. And I believe that's a good thing. I have 20 years plus in the markets with respect to portfolio management, and it is getting to be the point when you see markets being able to internalize things a little bit better. Again, from a more of a volatility standpoint, really, that starts to tell you that the phasing in or phasing out, let's say, of a previous issue or a previous problem the markets had, and a phasing in of the next market cycle have begun. And I believe that is starting to happen. Now, to quote many in the government, whoever you would like to quote, I think, because the messaging, while it's definitely different per state and definitely different per state or federal, the reality is this is an unprecedented situation. There are many moving parts to it. It is very fluid, and the virus has yet to be tamed. Certainly, but I believe in a lot of our data points from which we look at that we'll talk about briefly here are starting to show that some things are on their heels with respect to the spread. And so there is some good news out there. There is some light at the end of the tunnel. And at least for today, and I think for the last several days, as we've talked about in many of our commentaries, it doesn't look like the light at that end of the tunnel is another freight train, which is certainly good considering that we didn't know that that was the case potentially about a month ago. But I will tell you, as I turn this over to Paul Nolte in about 30 seconds, our team takes very seriously and very exceptionally the task of making sure that is not another freight train, in the sense of how we're positioning your portfolios, how our outlook is within Kingsview Investment Management on the several different managed portfolios that we have, whether that's core, multi-strat, dividend plus, pro cap, blue chips, and all of them, just to make sure that we have the best positioning on for you and your clients vis-a-vis the risk reward that those portfolios are set to deliver. And so as we keep analyzing data, as we keep looking at information as it comes in fast and furiously, just know that we're on top of that stuff. And so with respect to that, I'd like to pass the mic over to Paul Nolte, our Senior Vice President and Portfolio Manager within Kim. He's also a certified financial analyst and is also one that is able to tell us a little bit deeper, I guess, if you will, Paul, how the data actually goes into being interpreted as of today with respect to how we're kind of positioning portfolios and what our outlook is on that data, if you wouldn't mind delivering that. And by the way, certified financial analyst, I always say that it's chartered financial analyst, obviously. Paul, they're your letters, not mine. Please take over.
Thank you very much, Scott. You know, as we look through the data points, we finally have data now that reflects the beginnings of the government shutdown, the state shutdown, and everything that's impacted. We were getting the weekly jobless claims numbers, so we saw those data points, but we're getting a lot more now that are taking into impact now the full shutdown. And one that I would point to is retail sales. This is at the consumer level. So big surprise, you're going to see a lot of charts over the next probably 3 or 4 months that are going to look exactly like this. You're going to have a lot of data points, and then you're going to have this huge down spike or up spike, depending upon what kind of chart you're looking at, that's going to dwarf everything else. And this is important. This is, again, what's happening in the economy. It comes as no surprise, not much is going on in the economy. So we're going to see a lot of these numbers. Conversely, the good news on the retail sales numbers is everybody is going to the grocery store as opposed to the restaurants. So big surprise if you take a look at this chart. Again, it dwarfs anything that we've done on a month-over-month basis at the grocery store. So everybody's there buying their toilet paper, Clorox, and wipes, etc. So this is where we're at right now with a lot of the data points. So it can be argued that the stock market may be looking through a lot of these data points. We're down roughly 12%, 15% or so year to date. And the economic data is as terrible as it's been since '08, and in some cases since the 70s, and some since the Depression. So again, a lot of that goes to the Federal Reserve, what they're doing, the federal government, what they're doing, and the help that they're providing, and hopefully it finds its way into the overall economy. One of the things that's interesting here, if you take a look at the next slide, is, again, one of the things we look at, and this is kind of a noisy chart, but basically, how does the data points as they get released come out based estimates? So big surprise, the economists are missing estimates. And what will happen over the course of the next, 3 months or so, you're going to see very pessimistic estimates for a lot of the data points. The data will probably start to be better than those estimates, and that's when we'll see that line start to pick up a little bit. And normally when we see that line pick up, we will also see the markets pick up in response to that, because the economy is performing better than expected. So right now, we're now starting to understand what the current economy looks like. What are the data points? What are our reference points? And we finally get to understand that. We're now seeing governors getting together. There's a group out in the Northeast. There's the Midwest group. getting together and trying to figure out how do we open up the economy? How do we allow people to move about the country? Florida just announced, hey, by the way, we're going to open up beaches on a restricted basis. That was just announced here a little while ago. So the question that's come up, and I'm sure as you're talking to some of your clients, you're asking them, if we open up the economy today, what would you be doing? Would you go to the movie house? Would you go to the restaurant? Would you go to a bar? Would you go to the museum? And this one might be a little hard to read. We can certainly send it out to you. You can blow it up for your own check see. But in essence, the numbers on the far left are the ones that said, yeah, we're going to go out tomorrow. Absolutely. And when you look at that, most of those are less than 20% of the population will say, yes, we're going to go within the next 30 days. We're going to do that. The bulk of it is really 3 months, 4 months, maybe as much as 5 months before we say, yep, I'm willing to go out and spend money at the restaurant or go to the theater or whatever it might be. So my point to that is, what is the letter that we're looking at as far as the economic part of the recovery? And I think we're past the V shape. I think we're looking more at a U, or maybe even the Nike swoosh. So it's going to be a very gradual recovery. Think about it. If we allow restaurants to open up, we take out half the tables to allow for physical distancing. I don't need as many staff. I'm not generating as much in the way of revenue. So all of those things we're looking at. So this survey was actually kind of interesting to see what would people's reaction be. So right now, I think the general population, as much as we all need a haircut and would love to go to the beauty salon, they're scared. People are scared and nervous about moving about the country anytime soon. So that's kind of where we're at. It's a little bit of a dichotomy between the equity markets, which I think are feeding off of what the federal government, the Federal Reserve are doing, and the economy, which is going to take a time to recover. But we've been here before. We saw this in 2009 through to 2019. The economy did not perform as well as the equity markets. The equity markets are doing much better because of the Federal Reserve and monetary stimulus. We may be in a similar situation to that. So with that, we'll provide that transition back to you, Scott, to handle it.
Yeah, thanks, Paul. And really great aspects there, and many of the reasons that I love you, if I may say, which is this aspect of not only calling out the Nike swoosh, which is great because that's not heard in mainstream media. They're always pointing out letters, and it's like, is it an L? Is it a U? Is it a V? Which is love, obviously, but more so, it could be something more foreign or more unusual, like a Nike swoosh. So I appreciate that. And I think the other thing, Paul, that you pointed out that is absolutely essential in portfolio management is it's not so much, ladies and gentlemen, about the empirical data or the number on the data or the absolute value of the data, but what the market interpretation of the data is. And that's where I believe our investment committee really stands out with our decades upon decades of portfolio management experience, as well as the fact that we have a slew of portfolio styles and portfolio risk profiles, to use a rhyme there, that fit different objectives that a client may have. And I really like, Paul, the way you put that, as far as we could get bad data for months, but in our opinion, and as we've seen in some of the models that we run here, if the data is bad for months, but it stays bad, and it's like the level of bad doesn't get any badder, to use a word that's probably not in the English language, that's okay, because the market already is moving on. And that's kind of what we were talking about earlier in my opening remarks. So with that, to kind of counterbalance kind of the more fundamental market reaction to data, outlook, and current state of affairs, Buff Dormeyer is up next with respect to giving a bit of a, let's say, an approach to kind of more of a technical view of how we look at some of the actual real price action and the volume indicators and some of the other, say, institutional versus real versus retail money that is out there, from the standpoint of Buff using a lot of his proprietary analysis. As Alex mentioned, Buff is part of our investment committee and located in Fort Wayne, Indiana, and dials into our investment committee calls certainly now, but also comes to the meetings when we're able to and allowed to. And Buff, again, is a chartered market technician and somebody whom brings a lot of value and diversification to our team. So Buff, if you'd like to step in now and take the mic and talk a little bit about the charts and what we're seeing from those price levels and volume analysis, it's yours.
Hey, thanks so much, Scott. Last time we were together, we discussed a dynamic cocktail was a brewing. This cocktail consists of a formally vibrant economy combined with strong technical internals now being sparked by unprecedented easing actions by the Fed. As a technician, my job is to follow the smart money and mimic their behaviors as quickly and as accurately as possible. Coming out of a bear market, one of the telltale signs of institutional buying is up volume thrust days. This is where the market's upside volume dwarfs that of its downside volume by a ratio of 9-to-1 or more. Such an occurrence is particularly eventful when there is a cluster or grouping of these one-sided volume days. Previously, we pointed out a cluster of such of these signs occurring mid and late March. Last week, again produced another such cluster of 9-to-1 bullish volume thrust occurring on 4-6 and then again on 4-8. If you look at the chart that you have on the screen, they're noted by those big green bars, which are capital inflows, and pair those with the red bars, those tiny little red bars right below them in the chart. And guess what? If this chart was updated, you would see another one today. Now, this is a good segue into the next section, capital volume flows. Here we're looking at the same chart, but at the very bottom panel, illustrating the accumulation capital of inflows and outflows. Okay, the most critical bearish event in my work occurs when the trend of capital flow turns negative. This very event corresponded to the S&P 500 breaking its decade-old uptrend that dated all the way back to 2009. And at the same time, the advanced decline line also breaking its corresponding trend line. Any one of these events could and of themselves constitute a bear market, and they all happened simultaneously. The result was a rapid market crash. And after a 35% drop, the market then held its August of 2016 support levels at 2175, with the S&P hitting a low at that time of 2191. Yet, as capital low, at the same time though, the capital flows level only fell to their lows reached in August of 2019, just a few months ago. Now, this tells us, as violent as the price decline was, that smart money, the institutions controlling the most capital, employing the wisest minds, did not heavily participate in the sell-off. Of course, they didn't come in and step in and buy much either, at least not yet. But by March 19th, looking at the same chart, just a few days before the price bottom, this weekly capital weighted volume met its own support. And lately, what we've been witnessing is a return of strong capital inflows. And we're now right on the verge of breaking through capital flows resistance. And if we can do this, this would constitute a bull market in terms of capital weighted volume. Hasn't happened yet, but we're right on the cusp. Moving to the next chart labeled advanced decline line, not only are capital flows improving, but we can see the health of the market is also much improved by looking at our breadth indicators. Although not at a level considered to be trending higher yet, if we look at the percentage of stocks making new highs, you can see that this is starting to turn up. And then if we were to look at the next panel, the one right below that, labeled weekly advanced decline line, we can here again see that the advanced decline line, just like weekly capital inflows and outflows, is also right at the cusp of breaking into an uptrend. It hasn't happened yet, but we're getting really close. And lastly, if you look at the bottom panel of the percentage of stocks in uptrends, you can see that is now starting to turn up as well. And if we take all this data together, we can see that the breadth of the market is giving us encouraging signs about the market. Now, moving on to our next chart, that of market sentiment, we can again see the improvement in the sentiment of the market. And according to contrarians, one should sell when the crowd is buying or being greedy, and we should buy when the crowd is selling or feeling fearful. This investors' intelligence data tells us that we recently entered such an inflection point, as there are now more bears than bulls in their recent survey. And historically, such points have often provided us good entries. Finally, moving on to the next chart, the volume price confirmation indicator gauges whether the market volume is confirming or contradicting price. In terms of market extremes, the VPCI also can be used to detect market bottoms. The VPCI on the SPDR ETF gave a way too early V-bottom signal on March 4th. This is normally my go-to on finding capitulation points, as it provides the faster entries than using the data on the S&P 500 itself. However, this time it was way too fast. However, if we were to look at the same data on the S&P 500 index, that's the one on the very bottom panel. It V-bottomed on March 19th, just a few days before the actual low was put in on the market. And last week, if we were to look at the same data on a weekly chart, the S&P SPDR ETF produced the V-bottom as well. And at today's close, we also got the weekly VPCI V-bottom on the S&P 500. Confirming these other V-bottoms. Thus, all four capitulation signals by the VPCI volume price confirmation indicator are now into place. Going forward, the bulls need to hold 2750, as this is the former resistance point has now become our support level. Should we violate 2750, the next support resides between 2450 and 2400. Now, looking upwards, more resistance resides at 2900. This is staunch resistance. If broken, expect the bears to defend it heavily all the way to 3025. A break above 3025 puts us back into that decade-old uptrend channel, and it may mean to us and to the rest of society that life is returning back to normal. But keep in mind, we have S&P price resistance at 2,900. We have the advanced decline line resistance right above us, and we have the capital weighted volume resistance right above us. So this is a point of serious resistance. Doesn't mean we can't break through, but again, expect it to be heavily defended here.
Great, thank you, Buff. And I'm sure many of you see why we find Buff very valuable and interesting, and certainly deep in experience and depth with a lot of those calls and initiations of price levels because that's analysis, frankly, you can't get anywhere else, and analysis that I believe, as we've seen over the last several weeks, have been very valuable with respect to how these markets have behaved and the very, let's say, insubordinate trading that has been happening throughout the markets, both on the after hours markets, as I mentioned earlier on about a month ago, and certainly the markets during the daily sessions too. So Buff, thank you again, and really appreciate and look forward to more of your price volume analysis and such as we go through and approach some of those bigger levels. So with that said, Alex, if you'd like to handle any Q&A, if there is anything from the group of advisors that are listening, and anybody that would like to ask some specific questions of myself, Paul, or Buff, or anything more specific on the portfolios, we're happy to take those calls at this moment. Thank you.
Cool. Thanks, Scott. Yeah, and again, if you want to use the function on the Zoom conference at the bottom there, there's a Q&A portion. Just type your questions in and we'll happily answer them there. But I think in order just to kick things off here, fellas, I read a quote the other day that I've been thinking about a lot, and the reason I say that is because I think we're all asking the same question. And I think a lot of people are saying, when will economies return back to work? Like, that's the most poignant thing that I think people are thinking about, analysts too. But at the end of the day, what about the real question? I think the more relevant question is, when will aggregate demand recover to pre-virus levels? And I think we're asking two different questions. One, I think, might be the more appropriate question to ask. So maybe I'll open up to Paul, Buff, to kind of answer that with regards to seeing aggregate demand recovering to pre-virus levels. Thoughts, concerns?
Yeah, I'll start off, and then Buff, you can finish up. From an economic perspective, I think if you take a look at history, and that's really kind of the only way we can look at this, because we are in, as we all know, uncharted waters, but we have to have some reference points. I think we can probably say it's going to take us at least 3 months to 6 months before we see a bottoming in the economy and we start to improve. From that point, if the analysis that we're doing is correct and we are kind of in a swoosh type recovery, we would anticipate, and again, using history as a guide, that the S&P earnings numbers probably take about 2 years to get back to the old highs. So we'd be talking late 2021 and then maybe 2022 early. And then I think you look at what multiple do you put on that, and can you still put a 20 multiple on that, or a 25 multiple, which is kind of where we were prior to this market decline. So again, from an economic perspective, it's probably about a 2-year recovery, 2 to 3 year recovery. We saw something similar after 2009. Took a while to get back to the old highs before we started making new highs. We may be in that same type of path, maybe a little bit slower. It's going to really depend on what the consumer and how they embrace being able to go out and move about. Buff?
Well, this is really outside my purview as a technician. I guess maybe from a behavioral standpoint, it's going to come down to when the economy opens, right? And is this spending that has been, is it lost or is it delayed? And if it's delayed, we should see things improve rapidly. And if it's lost, then I think we're in a bad case scenario. Maybe Scott, you can weigh in.
Yeah, I agree, Buff. I think it depends on what kind of phase or what destruction phase we're in. And I believe, Paul, you made a good point. I think the multiple is justified by where we are in that cycle and if this is a temporary versus a permanent situation. Because as we've seen in refiring economies, there tends to be, and this is a word that I think has been used before, so I can't take credit for it. There's like an escape velocity mechanism sometimes, ladies and gentlemen, when it comes to an economy that's refiring on so many cylinders, that investors, again, looking at market behavior and how we really at Kingsview Investment Management try to interpret that kind of market tolerance, if you will, or the market appetite for risk. The investor will pay 25 or 30 times earnings in some cases because of the confidence in future growth. And certainly as that cycle tends to flatten out, level off, get more mature, then those levels will come down to more, as far as the multiples, to more realistic levels or more realistic, say, appropriations. But yes, I think that's really key to where these valuations go. And I think in some cases, it's an area maybe in some markets, like let's say, maybe it's hospitality, maybe it is more in retail, where maybe there isn't that big staff increase, and therefore there could be some better profit margins that are realized in these areas, or that they have to realize, versus maybe areas like tech or healthcare, where those areas are certainly still not feeling as big of a pinch or big of a downturn, and fire up even faster or quicker as we pull out of this thing. So that will be data that we continue to look at, and certainly I think a very interesting aspect as we get towards really the end of this whole malaise, and how that market structure or market shakedown turns out.
Great, thanks, gents. Another thing to note, I mean, I think it's crazy. I mean, we listen and we read and we see all this stuff happening. And last week, Goldman Sachs is saying, hey, look out for the next bottom and definitely going to test the bottom. And then yesterday, their analyst is coming out saying, no, we were wrong about that. We definitely think that we've already hit our bottom. So, I mean, no one has a crystal ball, right? I mean, our team in Chicago doesn't have a crystal ball, but what we do rely on very heavily is data, public data, and to shape our sentiment and all that. So at the end of the day, for the advisor, or the clients who are worried, who are scared, keep in mind that everyone is very not. I mean, sentiments change daily. So the best thing you can do as an advisor is to focus on keeping your clients on track to be long-term invested. I understand people can be, retiring in the next couple of years and things change. But for those people who have more long-term to go, focusing more so on their goals and making sure that they stay invested and focused on their goals is the most important thing that advisors can do right now. But gentlemen, thank you so much for all the thoughts, everything. Buff, all your stuff is all so awesome to hear, and we've been working close together the last couple of weeks, and it's really cool to kind of get inside your mind. Now, keep in mind, everyone who's listening, the VPCI that Buff it refers to is definitely a proprietary screen that he runs, and he's been written about with regards to Charles Dowd and technical analysts and active analysts. So it is industry recognized and is proprietary to him. So the fact that he's utilizing that and able to share that data with us is really, really important. The other thing to note, I sent out a lot of emails yesterday with regards to what's going on at Kingsview Investment Management in Chicago. We updated our video. So Paul, Scott, and Buff were on a video just kind of talking about the recap of the quarter. Another thing to note, our fact cards are up and running. So 15 days into the quarter, I'll give myself a break from Good Friday last Friday. But 15 days in, we're able to get updated numbers that have been GIPS compliant and GIPS approved. So those are all legitimate. And then finally, our quarterly write-up that we did, it is available on the knowledge base. It is available. So if you're having issues finding that, please let me know. Now, keep in mind, I'm going to send an email out at the end of the day here. Quarterly performance reports that are run via Orion are finalized. So if you are listening and you normally take a peek at those, take a look. Go through those. If there's any issues, let me know. But I'll get that was really basically it. But we have a lot of good things going on at Kingsview, Chicago. Really, really happy to share it with everybody. And we're really excited for the future. And we really appreciate everyone taking the time to be a part of this on a Friday. Like I said, market's up. I'm a happy guy. So if there aren't any other questions, I'll kind of lead you into the weekend. But if there is anything else, again, thank you everybody so much.